Most people think that once they retire, their monthly Medicare premiums are relatively fixed, only moving up slightly each year with inflation. You budget for your healthcare, you calculate your Social Security, and you assume that your monthly expenses are predictable. But there is a hidden mechanism buried deep within the federal tax and healthcare systems that can quietly disrupt that stability. Imagine taking a well-deserved lump sum distribution from your traditional IRA to pay off your mortgage, fund a major home renovation, or help an adult child with a down payment on a house. You pay the income taxes due on that withdrawal, and you assume the transaction is finished. Then, exactly 24 months later, a letter arrives from the Social Security Administration informing you that your monthly Medicare premiums have suddenly skyrocketed by hundreds of dollars per person per month. This is not an administrative error. It is the direct consequence of a financial rule that connects your current investment decisions to your future healthcare costs. If you are over age 60, or if you are already enrolled in Medicare, a single financial move today can create a compounding penalty that catches you completely off guard 2 years down the road. Over the next several minutes, we are going to break down exactly how this rule works, why the federal government looks backwards at your tax returns, and how a normal, responsible financial decision can inadvertently push you into a high-cost bracket. More importantly, we will discuss the practical strategies you can use to protect your retirement income from these delayed surcharges. This matter is critical because healthcare is often the single largest unpredictable expense in retirement. For senior homeowners, retirees living on fixed incomes, and surviving spouses, a sudden and unexpected increase in monthly bills can force difficult trade-offs. The financial system is highly interconnected, yet the rules governing taxes and the rules governing healthcare are managed by entirely different federal agencies. Because of this separation, thousands of seniors make completely logical choices with their personal savings, only to realize too late that they have triggered an automatic penalty. This is not just about losing a few dollars. For a retired couple, it can mean thousands of dollars in extra costs over 12 months. The danger is completely silent because nothing appears wrong when you make the withdrawal. Your financial advisor might help you take the money, your bank will process the transaction, and the IRS will accept your tax payment. No one issues a warning at the time of the transaction. The consequence only materializes much later, when your ability to adjust your financial strategy for that year has passed. Understanding this timeline is the only way to prevent a temporary spike in income from turning into an expensive retirement mistake. To understand why this happens, we must first look at a metric known as IRMAA, which stands for the Income-Related Monthly Adjustment Amount. In plain English, IRMAA is a surcharge added to your standard Medicare Part B and Part D premiums if your income exceeds a specific threshold. Medicare Part B covers your doctor's visits and outpatient care, while Part D covers prescription drugs. For the vast majority of Americans, the federal government subsidizes about 75% of the actual cost of these programs, leaving the enrollee to pay the remaining 25% as a standard monthly premium. However, if your income rises above certain federally mandated levels, the government reduces its subsidy, forcing you to pay a much larger share of the actual cost, up to 85% of it in the highest bracket. The hidden danger lies in how the government determines your income. The Social Security Administration, which handles Medicare billing, does not look at your current bank balance or your monthly retirement paycheck. Instead, they look at your Modified Adjusted Gross Income, or MAGI, from your federal tax return from exactly 2 years ago. This 2-year look-back period exists purely because of administrative delays. It takes time for the IRS to process tax returns and share that data with the Social Security Administration. Therefore, your Medicare premiums for the current year are dictated entirely by the financial decisions you made 24 months earlier. What people usually misunderstand is that this rule applies to all income, including the completely legal, one-time withdrawals you make from traditional retirement accounts. Let us look at a realistic example to see how this unfolds for a typical senior household. Consider a retired teacher named Eleanor, who is 68 years old. Eleanor lives comfortably on a modest pension, her monthly Social Security benefits, and occasional small distributions from her traditional IRA. Her total annual income usually hovers around $90,000, which keeps her comfortably below the initial IRMAA threshold for a single tax filer. She pays the standard, base premium for her Medicare Part B and Part D every month, automatically deducted from her Social Security check. One year, Eleanor decides it is finally time to replace the aging roof on her home and upgrade her 30-year-old kitchen. The total cost for the renovations comes to $60,000. Rather than taking out a high-interest home equity loan, Eleanor decides to do what she believes is the most responsible thing. She withdraws the full $60,000 directly from her traditional IRA to pay the contractor in cash. She knows the withdrawal will count as taxable income, so she sets aside enough money to pay the extra income tax when April rolls around. She pays her taxes, files her return, and enjoys her newly renovated home, believing the financial transaction is fully settled. The consequence hits Eleanor 2 years later in November. She opens her mailbox and finds an annual notice from the Social Security Administration. The letter informs her that because her modified adjusted gross income from 2 years prior was $150,000, consisting of her usual $90,000 income plus the $60,000 IRA withdrawal, she has breached the first IRMAA threshold. As a result, her monthly Medicare Part B premium is adjusted upward by nearly $80 a month, and her Part D premium receives an extra surcharge as well. This means Eleanor must pay roughly $1,000 in extra healthcare premiums over the course of the upcoming year, simply because she fixed her roof 24 months ago. Here is the part most people miss. IRMAA is not a gradual, progressive tax. It is a cliff-based system. If your income exceeds a threshold by even a single dollar, you are pushed entirely into the next bracket, and you must pay the full surcharge for that tier for the entire 12-month period. If Eleanor's income had been just $1 over the limit, the penalty would be the same as if she had been $20,000 over it. For a retired couple filing jointly, the stakes are twice as high because a single joint income spike triggers the surcharge for both spouses simultaneously, doubling the total household financial damage. This is where the paperwork becomes more powerful than the promise. Many seniors argue that a one-time withdrawal to repair a home or pay off a debt should not reflect their ongoing everyday financial status. They believe the government will see that it was an isolated event. However, the system is fully automated. The computers at the IRS flag the adjusted gross income line, send that figure to the Social Security Administration, and the premium adjustment is generated without any human review or common sense filters. The next mistake is quiet, because nothing looks wrong until your family needs the money. Let us examine what happens when a senior passes away, leaving behind a surviving spouse. This is a common scenario where the look-back rule creates severe emotional and financial stress. When a spouse dies, the survivor often experiences a drop in income, such as losing the smaller of their 2 Social Security checks. However, their tax filing status also changes from married filing jointly to single. The income thresholds for a single filer are significantly lower than they are for a married couple. If the couple took a large IRA distribution together during their final years to cover medical expenses or modify their home, the surviving spouse may find themselves facing high IRMAA surcharges 2 years later, precisely when they are trying to adjust to living on a single income. Before you change anything, you need to understand why the usual financial advice can backfire in this scenario. Many traditional financial experts advise seniors to defer taking money out of their IRAs for as long as possible to let the tax-deferred growth compound. While this sounds logical, delaying withdrawals can force you into a position where your required minimum distributions, or RMDs, become so large that they permanently push you over the IRMAA thresholds once you reach your mid-70s. Instead of enjoying a low-tax retirement, you inadvertently create an annual, recurring spike in your income that keeps your Medicare premiums permanently elevated. The intersection of IRS withdrawal rules and Medicare premium brackets requires a completely different approach to managing your savings. Now, before this sounds overwhelming, here is the good news. There are specific, practical steps you can take to shield yourself from these delayed premium increases, or to fix the problem if you have already received a notice from the Social Security Administration. First, you must map out your income timeline against the actual federal brackets. Every year, the government publishes the updated IRMAA thresholds for the upcoming year based on inflation. Because the rules utilize a 2-year look-back, you should always look at your current year's income with an eye toward what your Medicare premiums will be 2 years in the future. If you are planning a major expense, pull out your tax returns from the previous year, look at your adjusted gross income, and calculate exactly how much headroom you have left before you hit the first bracket limit. The second step is to alter the way you space out large distributions from traditional retirement accounts. If Eleanor, our retired teacher, had known about the 2-year look-back, she could have split her $60,000 roof withdrawal across 2 separate tax years. By taking $30,000 in December and $30,000 in January, she might have kept her income completely under the threshold in both years, avoiding the cliff penalty entirely while still getting her roof repaired on time. Spacing out your withdrawals requires planning, but it is one of the easiest ways to keep your income level predictable. Third, look into utilizing alternative, tax-free sources of funding for your large life expenses if they are available to you. Withdrawals from a Roth IRA, for example, are generally entirely tax-free and do not count toward your modified adjusted gross income for Medicare purposes. Similarly, if you hold a home equity line of credit, borrowing against your home's equity does not create a taxable income event, whereas a traditional IRA withdrawal does. While borrowing money carries its own costs and interest rates, you must calculate whether the interest on a short-term loan is cheaper than the hundreds or thousands of dollars you might lose to elevated Medicare premiums over 12 months. Fourth, if you are charitably inclined, you can use a tool known as a Qualified Charitable Distribution, or QCD. If you are aged 70 and a half or older, the IRS allows you to transfer up to $100,000 per year directly from your traditional IRA to an eligible charity without that money ever counting as part of your adjusted gross income. This allows you to satisfy your annual required minimum distributions, or support a cause you care about without inflating the income number that the Social Security Administration uses to calculate your healthcare costs. Finally, if you have already received an IRMAA notice in the mail because of an income spike, you need to determine if you qualify for an appeal. The government allows you to request a formal reconsideration of your premium increase using IRS Form SSA 44. However, you cannot appeal simply because you dislike the rule or because the withdrawal was a one-time event for a home repair. The Social Security Administration will only lower your premium if the income spike was caused by what they define as a life-changing event. These specific events are legally defined and include the death of a spouse, marriage, divorce, the annulment of a marriage, retirement, or a work stoppage, a significant reduction in work hours, the loss of an income-producing property due to a disaster, or the termination of a traditional defined benefit pension plan. If you experienced one of these specific events during or after the tax year in question, you can submit Form SSA 44 along with official documentation, such as a copy of a death certificate, a letter from an employer confirming your retirement, or tax documents showing your new, permanently lower income. If approved, the Social Security Administration will recalculate your premiums based on your current, lower reality rather than your old tax return, providing immediate financial relief. Rules can vary significantly depending on your specific filing status, your state of residence for local taxes, and your overall asset structure. So do not make sudden changes to your accounts based only on a video. Use this information as a direct checklist of what to review with a qualified tax professional or certified financial planner who understands the specific intersections of retirement tax law and healthcare enrollment. The last point is the one families usually discover too late. Retirement requires looking at your finances as a complete, integrated system, rather than looking at individual accounts in isolation. To recap what we have discussed today, remember that a traditional IRA withdrawal is treated as ordinary income by the federal government. Because Medicare utilizes a strict 2-year look-back period, any spike in your income today will directly dictate your healthcare costs exactly 24 months from now. The IRMAA system operates on strict, unyielding cliffs, meaning a single dollar over the threshold triggers the entire penalty for a full year. You can protect your household by monitoring the annual income brackets closely, spacing out large distributions across multiple tax years, utilizing tax-free pools of money like Roth accounts when possible, and using Form SSA 44 to file an official appeal if your income dropped due to a qualifying life-changing event, such as retirement or the loss of a spouse. If you want to keep your retirement planning secure and avoid these types of hidden financial traps, take a moment to review your paperwork this week. Tell me in the comments below, have you ever received an unexpected notice from Social Security regarding your premiums? Or are you planning a major retirement account withdrawal soon? Write the word premiums in your comment if you would like me to create a simple, plain English guide breaking down the exact income brackets and thresholds for the upcoming year so you can check your own safety margins. Please share this video with the person in your family who handles the financial planning or keeps the tax records, and subscribe to the channel to ensure you never miss a warning about the silent mistakes that can impact your hard-earned retirement savings. Thank you for watching, and take care.